Genesis HMAS Deconstruction Engine online.
The 2026 artificial intelligence ecosystem reports over $1.2 trillion in nominal wealth across its top executive cohort. Market consensus treats this accumulation as evidence of a sustainable infrastructure expansion. Forensic analysis reveals a severe structural detachment. Stated net worth is currently decoupled from actual fiat liquidity, leaving the sector's dominant entities reliant on highly encumbered asset bases. Institutional allocators are deploying capital under the premise that they are funding the next generation of global infrastructure. The Bubb-lionnary engine indicates otherwise. This data shows the market is financing a closed-loop reciprocal capital architecture, where the net worth of key architects is a byproduct of self-referential flows. Relying on these nominal valuations without auditing the underlying liquidity creates a systemic vulnerability. When the valuation-liquidity gap necessitates a correction, the architects of this system must find a new source of capital to sustain their infrastructure. We audit this systemic anomaly using the Bubb-lionnary engine. This quantitative stress test is designed to map closed-loop capital flows and identify the exact mathematical limits of private sector liquidity. The objective of this analysis is to identify the point where speculative private wealth exhausts its capital depth, necessitating a sovereign bailout. Our model utilizes specific sector-dominant individuals and corporations strictly as pedagogical proxy variables. These subjects function as analytical placeholders to represent the current peak of asset concentration. This diagnostic excludes market sentiment. By utilizing strict mathematical models, we can measure the true structural resilience of AI capitalization against systemic shocks. Standard operating cash flow metrics are structurally compromised, failing to represent organic economic yield. Inflated by the circularity ratio, for every dollar invested by cloud providers, 85 cents returns as data center revenue. This is vendor financing disguised as market demand. To find the true operating cash flow, we multiply the declared OCF by 1 minus this circularity constant. The result exposes the phantom yield. A declared $500 million in revenue, once stripped of this round-tripping capital, represents only $75 million in actual organic yield. Major infrastructure providers are currently the primary source of these related party revenue loops, exchanging compute capacity for equity. Because the organic yield is so compressed, the entire ecosystem operates on a fraction of the liquid cash suggested by public ledgers. We calculate enterprise support via the burn-to-backed ratio. The numerator tracks synthetic risk, market valuation multiplied by the margin collateral ratio, accounting for founders pledging shares for personal debt. The denominator represents liquid reality, applying a 0.45 asset decay constant to reflect aggressive hardware depreciation. A 45% annualized depreciation rate means hardware clusters have an effective life cycle of only 24 to 36 months before becoming inefficient against new architectures. This hardware is the only tangible collateral in the system. Its rapid obsolescence is the central constraint of the model. This creates the asset decay paradox. As the foundational hardware physically rots, the margin call risk explodes, proving that current valuations are structurally unbacked. We measure the system's remaining time using the fragility of insolvency equation. The numerator combines accumulated debt and quarterly burn rate, multiplied by sentiment volatility, tracking how fast consensus demands immediate utility. We then divide this entire debt load by the true operating cash flow. Because organic yield is so low, the fragility metric spikes toward infinity. This represents the speed at which operational burn exhausts remaining cash reserves. This metric identifies the threshold where institutional lenders are mathematically required to execute liquidation clauses. The engine combines the mirage gap and the velocity of ruin to reach its terminal metric, the systemic collapse limit, or beta L. Executives attempt to lower this score using sentiment capital. This is narrative armor, the claim that a lab is too intelligent to fail or acts as a vital asset for national security. But this defense provides diminishing returns. Logarithmic narrative protection cannot offset the exponential growth of mathematical debt. At a beta L threshold of 350, the entity reaches its terminal elasticity coefficient. This is the point where the velocity of debt obligations outpaces the functional capacity of the market to generate fiat liquidity. An entity at 350 is mathematically incapable of surviving a 30% liquidity contraction. At this level, the gap between nominal collateral and available market depth is so wide that a standard drawdown triggers mandatory cascading liquidations. This 350 limit identifies the exact microsecond where private capital reaches terminal exhaustion, making a total collateral reconciliation unavoidable. When the 350 limit is breached, secondary market depth for private equity evaporates. To prevent total liquidation, corporate architects are deploying the compute ownership doctrine. This strategy rebrands depreciating server clusters as foundational pillars of national sovereignty. By reframing hardware as a sovereign reserve asset, they extend their investment horizon. This doctrine shifts the focus away from private markets toward state-backed investment vehicles and sovereign wealth funds. The compute ownership doctrine is a fiduciary distraction designed to transform commercial liabilities into geopolitical hostages. The architects aim for systemic intelligence essentiality. They seek to integrate their survival with the strategic doctrine of national supremacy, forcing the state to absorb their massive operational burn rates. This facilitates a sovereign-led restructuring sequence that supersedes traditional bankruptcy. This is the sovereign put option, the assumption that the state cannot permit the liquidation of frontier-scale compute assets. Corporate architects are already interfacing with global legislative bodies to position their illiquid hardware as the vital organs of state power. The generative AI cycle concludes with a highly engineered, sovereign-backed bailout. Institutional allocators who ignore the Bubb-lionnary engine risk positioning their capital as the residual exit liquidity for a terminal transition from private equity to state-level debt.